Stocks are continuing to fall, and the S&P has now lost trillions of dollars in value. Tesla is down 51%, Nvidia is down 27%, Amazon down 16%, Google 20%, and even Microsoft is down almost 20% from its all-time highs. There's continued worries around tariffs and if they will cause a global recession. Even today, the talks of tariffs have escalated, with Ontario's Premier, Doug Ford, saying he would shut off power to the United States if Trump continues to place tariffs on Canadian goods. Trump then responded by saying he will increase tariffs on Canadian steel and aluminum exports to 50% if Doug Ford does not back down. And it seems like every day there's escalating news about tariffs and international trade, which is causing significant amounts of uncertainty and rising fears that we're entering a global recession. So in today's video, I want to discuss how I am handling all of this uncertainty and volatility in my portfolio. So the first thing that I want to do is show you how my portfolio has been performing with the overall market selling off, because I have not been immune and my portfolio is down quite a bit. So here we can see that my portfolio returns peaked on January 24th, 2025 at 62% versus the S&P's 33.8%. And as of today, we can see that my returns are now all the way down to 38.3% versus the S&P's 22.4%. And the last time that my portfolio was around this percentage of returns was on October 23rd of 2024. So my portfolio has basically lost about 5 months of returns now. And since its peak, I am down over $130,000 now. So I've literally lost about $130,000 in portfolio value since January 24th. So then the question is, how am I handling this and what am I doing? And what I'm doing is I am continuing to deploy capital into stocks that I think are looking the most attractive in my portfolio, and I am not trying to get emotional or anything like that. I do believe that emotions are your enemy as an investor, because they start to cloud your judgment, make you fearful when things are falling, and cause you to miss opportunities. And they also just cause you a lot of stress, and you ultimately end up making emotional decisions. So what I do to remove emotions in my portfolio is I always try to focus on the business behind the share price. So when my stocks are falling, and pretty much every single one of my stocks is falling right now, what I do is I look to the business to make investment decisions. And I will discuss some stocks that I have been buying in my portfolio later on in this video, but I always make my investment decisions based on the business behind the share price and not based on what the share price is doing, especially in the short term. And I have found that when I focus on the business behind the share price, I can make more rational investment decisions and take advantage of volatility much easier. If you have also been a viewer of my channel over the past few months, I have been telling my audience that I think it's a great time to start building your conviction in your positions before a potential market correction happens. Because if a potential market correction happens, then you will have done all of your work and all of your research, and you will be mentally prepared for it. I did that. I built my conviction in my positions, and now that I have that conviction, I am continuing to execute and deploy capital into those positions. So if you have not yet strengthened your conviction in your stocks and in the businesses you own, then I think that there is no better time to do that than right now. For example, last night when I was laying in bed trying to fall asleep, I was reading the transcripts of the businesses that I own from their most recent earnings reports. So I am brushing myself up on all of the recent news and what the management was saying about these businesses, and really just increasing my conviction and redoing my research in these businesses. And I found that that is really calming my emotions, calming my nerves, and again, getting me focused on the business and allowing me to take advantage of the opportunities that are appearing in the market today. Now, I also want to talk about this screenshot from JP Morgan's Guide to the Markets. This is a monthly report that they put out. And in their most recent report, which was February 28th of 2025, we can see that the S&P had a forward price to earnings ratio of 20.5 at the same time as 10-year government bonds were offering 4.2%. Now, back in January of 2022, which was before the 25% stock market correction happened in that year, the market was trading for a forward price to earnings ratio of 21.4, and the 10-year government bond was yielding 1.6%. So basically, as of February 28th, 2025, the market was actually slightly more expensive, and bond yields were yielding more, which ultimately caused stocks to look even more expensive. So in February, I do think that the market was priced quite high and for near perfection, and for a very rosy future outlook. So now with all of the uncertainty, I think that it's only fair for the market to come down and maybe price in a little bit more uncertainty. I also think that a correction is quite healthy for the market, again, because prices got quite high. And I'm a happy buyer into a market correction, and we're going to continue talking about that in this video. But first, I want to talk about an interesting theory that I have been hearing on social media. People are speculating that Trump is tanking the stock market and trying to cause a recession to lower interest rates before the US debt needs refinancing. The US is estimated to have $7 to $9.5 trillion worth of debt refinancing in 2025. This debt was taken on during the COVID era when interest rates were essentially 0%. So now that rates have risen, this debt maturing and needing to be refinanced will cost the US a lot more money. Estimates are that this debt refinancing at current interest rates could be in the $200 to $300 billion range. So people are speculating that Trump is willingly causing a recession to get the Fed to lower interest rates ahead of this refinancing. And then these people are saying that once interest rates drop and the US refinances its debt at lower interest rates, then Trump is going to relax and the economy and everything is going to rebound, and he's going to loosen up on tariffs and cause or create more certainty for investors. Now, I have no idea if this theory is valid, but it does kind of make sense. And it goes back to that Charlie Munger saying of, show me the incentive and I will show you the outcome. So if Trump can tank the market and cause a little recession that ultimately causes the Fed to lower interest rates, then he could potentially be saving the United States $200 to $300 billion per year on interest payments. So he does have a pretty large incentive to do this. And who knows, maybe he's playing 3D chess or something like that. But I just wanted to share this theory because it is out there right now and it seems to be gaining traction. So now let's move on to a discussion about stock market volatility, because I have been getting a lot of messages about people being fearful during all of this downturn and all of the selling that has been going on recently. And I think that this is fair, especially for newer investors. For example, I recently got asked by someone who entered the market halfway through 2022 after the market started rebounding, how to handle their first stock market correction and potentially their first recession. So I think that this is a very valid question, and I want to discuss how I think about this and how I think investors should think about stock market corrections as well. So what I want to do is read you some passages from my book where I wrote about stock market volatility. So this says, if you're not willing to act with equanimity to a market price decline of 50% 2 or 3 times a century, then you're not fit to be a common shareholder and you deserve the mediocre results you're going to get. And this quote is from Charlie Munger. Then I write, your perspective is the lens through which you view the world. This chapter is going to be dedicated to changing your perspective on stock market volatility to emulate how the best investors throughout history have perceived it. Most people perceive volatility as a risk, but in reality, it is what creates investment opportunities. Volatility causes many people to become uncomfortable and worried about their investments. This can cause them to make emotional decisions based on what stock prices are currently doing, instead of making rational decisions based on the fundamentals of the businesses they own. Why is volatility perceived as risk? Because every stock will go through periods where they fall 30%, 40%, 50%, or even more. And if you give in to the fear and sell when your stocks are down, then you will allow volatility to create losses. You could own the best stocks in the world and still lose money if you allow your emotions to get the best of you and sell just because stock prices have gone down. You have to become comfortable seeing your stocks decline if you're going to succeed as a long-term investor, because it will happen to you. This is something you need to accept and come to terms with, because there's no avoiding it. For you to never see the prices of your stocks decline, you would have to time the exact bottom of every stock you ever buy for the rest of your life. The odds of that are next to impossible. Therefore, you will almost certainly see your stocks fall, and on multiple occasions. Since you cannot time the bottom, you should not feel remorse or regret if a stock declines after you buy it. It is so easy to let the voice in your head say, I should have just waited, I could have timed this so much better. Was I wrong? What should I do now? But you have to realize that this voice is driven by your emotions, and it is trying to get you to make decisions that are based solely off of short-term price movements. The key to being a successful long-term investor comes from being able to stay rational when other investors are letting their emotions get the best of them. In fact, Warren Buffett believes that successful investing is more about controlling your emotions than having a high IQ, and I agree with him. Fear clouds your mind with doubt and worry, making it difficult to see the opportunities passing by. Therefore, you have to remain optimistic about the future when stocks are falling, and you have to trust that humanity will overcome the countless problems we face. An optimistic mind allows you to be hopeful that difficult times will not last and that better days will come. This enables you to spot and seize opportunities, even amidst the challenging times, since you know they will only be temporary. To take this a step further, the best investors do not just have the ability to remain calm when stocks are falling, they enjoy it. These intelligent investors have shaped their perspectives to view falling stock prices as a good thing for their long-term returns. They gain this perspective by understanding that as stock prices fall, their future returns increase. As a long-term investor, your best returns often come during times when the market is in turmoil and everyone is predicting doom. So some of the key points from this text in my book is that you have got to be okay seeing your portfolio and the stocks you own go down. It is actually normal to see your stock prices decline by 30, 40 to 50%. And every stock in the market could see declines like this. So as a long-term investor, you have got to know that this can happen to you, and it most likely will happen to you. In fact, Charlie Munger has had his portfolio decline by 50% 3 to 4 times in his lifetime. And every single time, he did not sell out of his stocks or anything like that. He actually says that as an investor, you've got to expect this to happen. And when it does, you basically have to throw your emotions out of the window and just continue focusing on the businesses that you own and the long term. Another key point that I talk about is that you have got to expect the prices of your stocks to decline after you buy them. And the argument that I use here is that for you to never see your stocks go down would mean that you would have to buy the exact bottom on every single stock you own for the remainder of your life, which is simply not going to happen. It's pretty much impossible, unless you're extremely lucky. But again, it's probably not going to happen. So you have to expect that the prices of your stocks are going to go down after you buy them. And it's best to have this mindset when you're buying stocks and be mentally prepared for it to happen. It will help you keep your emotions in check and view falling stock prices for what they are, which is an opportunity. Now, I also want to read you a quick passage from The Intelligent Investor, which is on page 17, and this says, "The intelligent investor realizes that stocks become more risky, not less, as their prices rise, and less risky, not more, as their prices fall. The intelligent investor dreads a bull market, since it makes stocks more costly to buy. And conversely, so long as you keep enough cash on hand to meet your spending needs, you should welcome a bear market, since it puts stocks back on sale. So take heart, the death of a bull market is not the bad news everyone believes it to be. Thanks to the decline in stock prices, now is a considerably safer and saner time to be building wealth." So what this passage is saying is that high stock prices are actually more risky for buyers, and low stock prices is actually less risky. The book is also making the argument that it's actually a better time to be a buyer of stock and to build your wealth in bear markets when prices are low and prices are declining. And what the intelligent investor also says throughout pretty much the entire book is that you want to shift your natural thinking, because naturally we like to see stock prices go up. It gives us a great feeling. It makes it fun to own stocks. Our portfolios are going up in value. We feel richer. But this is actually not the best time to be building wealth. And it's actually the best time to be building wealth when stock prices are going down. So you have to shift your natural thinking from stock prices going up is a good thing to stock prices going down is a good thing. And you have to shift it from being fearful when stock prices are going down to actually being excited. And this is a very hard thing for investors to do. Warren Buffett has actually said that he doesn't believe every person has this ability because, again, you're literally you're flipping the natural hardwiring of your brain. And this takes time and it takes experience. And I think that this is what people have to do, especially if this market decline continues. Now, I also took some quick notes with my thoughts on the market today, volatility, the trade war going on, and how I am thinking about this market. So here I say, I think the current North American trade war is unsustainable. I do not think it's in any of our country's best interests to be fighting each other economically. And therefore, I simply do not think that this turbulence will last in the long term. And this all goes back once again to Charlie Munger's saying of show me the incentive and I will show you the outcome. And I think that North America has a massive incentive to work together and make our economies stronger together. Because the reality is Canada, the United States, and Mexico are all significantly stronger economies when we work together. So I think that we're going through this turbulent period where we're trying to figure it out. And I actually think that we're all just coming out, taking swings at each other, and trying to basically make us all look as tough as possible in the short term, because we don't just want to make it look like we're all backing down. For example, when Trump comes after Canada and puts tariffs on Canada, it's not in our leaders' best interest, no matter whether they're conservative or liberal. It's not in their best interest to just roll over and say, yeah, okay, Trump, you can have your way with our economy. I think that makes them as a leader look bad. And I don't think anyone as a leader wants to look bad. So their only choice is to retaliate to some degree. So they throw a punch back at Trump. And then it's not in Trump's best interest, especially given his character, to just roll over either. And he's not going to say, you know what, Canada, you're right, we're going to remove tariffs. So what he does is he throws a punch back, and then our leaders throw a punch back, and then they just get into this fight. But what ultimately is going to happen is they want to throw their punches, they want to look strong, but eventually I think they're going to come to the table and try to work out a deal that makes the most sense. So we're currently in the punches, we're currently in the fight, we're in a lot of uncertainty, we're in a lot of volatility, but I strongly believe that it is not in any country's best interests for us to continue fighting like this. So I think it's going to stop. I don't know when, but I think it's going to stop, and I think our countries are going to work out a deal that ultimately makes our country stronger, because that is what the ultimate goal is. Now, again, I don't know when this is going to happen, and in the short term, it is causing a ton of fear, uncertainty, and volatility. But as a long-term investor who believes these issues will be irrelevant in the future, I can take advantage of the discounts they're creating in the short term. So what I am doing is I'm having faith that our countries are going to work this out, because it is in their best interest to work this out. So in the meantime, I am taking advantage of all of this uncertainty by buying cheaper stocks. And you guys also have to know that stock prices get cheap during uncertainty. When everyone is certain that the economy is going to be great and that the future is going to be amazing, stocks don't sell for cheap prices in those times. Stocks sell for cheap prices when people are fearful, there's a lot of uncertainty, and it's scary to buy stocks. And this all goes back to investors having to be able to shift their thinking. And you have to be able to look at the fear in the market and the cheap prices in the market and still be buying stocks on the way down. That's literally how you time the bottom, is you have to be able to be willing to buy on the way down. So that's what I'm doing. I am trying to view all of this uncertainty and take advantage of it by simply continuing to buy stocks that I believe are high quality and have great fundamentals. And currently I'm buying them at a discount. So that's what I'm doing. I am continuing to buy stocks as the market drops. So then the question is, which ones am I buying and why? So if we head back over to Stock Unlock, this is not going to surprise anyone, but I am continuing to add to my Brookfield position. Brookfield is now in about a 20% correction with Google, Microsoft, Amazon. It's not immune. It's in about a 20% correction from its all-time highs. I think this business is going to be just fine, and this business is one that thinks over the long term. I'm going to be going through a Bruce Flatt interview, and he's the CEO of Brookfield Corporation. He recently did an interview that I thought was incredible, and he just continued hounding that this is a business that focuses on the next 25 years. They don't even care about the Trump administration. They don't care. They're thinking about what can we do today that's going to matter in 25 years. In that interview, Bruce also said that today, what people are worrying about is irrelevant. This trade war that's going on is irrelevant to the long term. This inflation that's going on, this decoupling and deglobalization, it's going to be irrelevant even in 10 years. That is what he was saying. And this is what I love to hear, because I completely agree. So I think the CEO of Brookfield is incredible. I think this business is focused on growing shareholder value over the long term. And I think the business is going to be just fine over the long term as well. So while it's in a 20% correction, I am definitely taking advantage, and I'm continuing to add to my Brookfield position, which is the largest position in my portfolio by far. Moving on to the second stock that I bought today, this one is Amazon. Amazon, as I showed, is in about a 16% correction, and I think that Amazon has one of the largest moats in the entire stock market. I also think that Amazon is going to continue growing over the long term. So while this stock is in about a 16% correction, I am using this as an opportunity to continue adding to my Amazon position. Moving on to the third stock that I bought today, this one is Melli. Now, I recently discussed Melli on my channel after it had its earnings, and its earnings were phenomenal. This business is continuing to grow by 30 to 40% annually, and its market cap is now under $100 billion. This company, I believe, can produce about $5 billion in annual cash flow today. So it's trading for under 20 times cash flows, and it's growing its business by 30 to 40% per year. So essentially 20 times cash flows for 30 to 40% annual growth, I think is a very attractive price, and I think this business has a long runway ahead of it. So I am using this dip in its share price to continue adding to my position as well. Now, the fourth stock that I bought today is goeasy. This one is a Canadian subprime lender, and I think that the market is extremely bearish on this one. It's now in about a 30% correction from its recent highs, and this stock I think is just getting ridiculously cheap. Now, to be clear, the stock has also not produced returns for over a year now, and it's become the third largest position in my portfolio. So people have been asking me, what am I doing and why am I buying this one if it's been going down? Well, it's down now for over a year. And the answer is, I don't look at the share price to make decisions. I look at the fundamentals of the business behind the share price to ultimately make my investment decisions. And goeasy's business has been continuing to grow incredibly well. Its revenue is at an all-time high, earnings are growing, basically every metric for this business is growing at 20% annually, and now its price to earnings ratio is under 9, which ultimately means that it has an earnings yield of over 11%. They just increased the dividend by 25% in their most recent earnings. They also increased their outlook for 2025 and their 3-year outlook all the way to 2027. So the management of the business seems to be confident because they increased the dividend and they increased their guidance for this year. Additionally, the business is continuing to grow and its price to earnings ratio is now under 9. So I think that there's a disconnect here between what the market is expecting and what the business is actually doing and performing and what the management thinks here. So I have continued to buy this one. And again, it's the third largest position in my portfolio now. And as it continues to fall, I will continue to buy it. And I think that this one is a clear example of the stock price going down at the same time as the business's fundamentals are growing. And as long as that continues to happen, then I will continue to buy this stock. But that is going to wrap up the video for today. And I just wanted to make a quick video explaining my thoughts and what I think about the market and some updates. If you did enjoy this video, please remember to leave a like on it. And if you're new here and you want to stick around and see more stock market related content like this, then please consider subscribing to my channel as well, because I am going to be doing my best to continue updating you guys on the market events and how I am navigating turbulent and uncertain markets. So again, if that resonates with you, then please consider subscribing. But as always, thank you all so much for tuning in. I truly do appreciate it, and I hope to see you all again in my next video.